Welcome to the Personal Finance Podcast for doctors with Meena Shriram and Chanda Varma. This podcast aims to simplify all aspects of personal finance and help you make smart and informed choices about money so that you can live happier and stress-free lives. Today's episode is brought to you by Chanda Varma, who is a financial coach and vice president with the doctor practice at MFA, the only company in India having a dedicated practice for doctors, helping them plan and achieve their financial goals. Established in 2005, MFA is recognized as the most trusted and respected firm in the industry and have built this reputation by always putting their clients' best interest above everything and taking care of their money the way they would do it for their parents or best friends. Over the last 8 years, Chanda Varma has interacted with more than 3,000 doctors and has been a speaker at medical conferences and conducted many financial literacy webinars for doctors. Needless to say, she understands the finer-most nuances of a doctor's financial life. Do listen to this episode, and now over to Chanda.
Hello, I'm Chanda Varma. I welcome you all to the second episode of our podcast series meant especially for doctors. In the first podcast, we spoke about why planning finances early in life is very important for doctors, as their life cycle is completely different from other professionals. In the next few podcasts, I shall cover the 5 common mistakes that doctors should avoid when it comes to making money decisions. Today, doctors, let's speak about the number one and the most common mistake that you need to avoid, and that is taking life insurance policy as an investment product. Now, we have met more than 3,000 doctors in last 15 years, and 90% of them have told us that they believe that insurance policies are one of their main investment assets, and very proudly so. Whether it's pension plans, children's plan, 25-year money-back plans, whole life plan, click to invest, Jivananand, etc., etc. I have seen that most of you take these policies predominantly for 2 reasons: supporting your child's need in future and providing for some amount of safety, like a pension amount, for you or your spouse at a later stage in life. These needs are valid, important, but insurance policy is not the solution. But we understand why doctors make this mistake. See, doctors are the most intelligent section of the society. But when it comes to managing money, unfortunately, the approach is very ad hoc. Reason being that finance is not taught in medical schools. Therefore, most of you have admitted that there is a lack of interest, a lack of understanding of finance and numbers. And so, whenever insurance policy is explained to you as a solution for your children's future or for your future needs, you fall for it. And secondly, you have very busy schedule, and that leaves you with very little time for anything else, and planning finances takes a backseat. Hence, this podcast today on insurance. And who better than a doctor, one of you, to explain this with his own experiences and learnings about investing in life insurance policies. I am in conversation today with Dr. Viswanathan. Dr. Viswanathan is an interventional cardiologist with more than 35 years of experience. He has a well established and reputed practice in Mumbai and is associated with Jaslok Hospital for many years. A well read and an astute investor, Dr. Viswanathan often jokes that if he wasn't a doctor, he definitely would have been a finance professional. He has been writing articles and has conducted talks for his colleagues on managing personal finance. Welcome, Dr. Viswanathan. It's great to have you on this podcast, and thank you for taking the time to be here and sharing your thoughts.
Thank you, Ms. Varma. It has been a great experience talking to you on various subjects. Today, we are going to discuss insurance and its relationship to doctors. And I would say that this talk is more related to my experience with insurance, my, or what you call, misadventures with insurance, which has taken place in the last 35 years. I would request my doctor friends not to commit their own mistake, learn from mistakes of mine. The mistakes of mine were in the field of investment as well as insurance. If you can learn from that and correct your course, it will be beneficial to you.
Actually, Dr. Viswanathan, you are from that 10% of the doctor community which is financially savvy. And yet you just said you made mistakes when it came to insurance. So, could you tell us a little bit about your experience? How was your journey of investing in insurance policies?
When I started practice, many people started approaching me and I took insurance. And then subsequently, I realized they were not right for me. And then I corrected course and again corrected course. For a period of time, I realized that whatever insurance that I took, not all of them were beneficial to me. And possibly most of the doctors might be facing the same difficulty. Insurance is a very necessary component of our life. Insurance covers the unexpected. You cannot buy a car without an insurance. I wish they also make such a compulsion for making the life of a person, life insurance for a person compulsory. For doctors, it becomes more important because they are very late bloomers. They start earning very late and they are in their peak of their career only for about 10 to 15 years or 20 years, beyond which the earning capacity goes down. And if the insurance is properly handled, they can get a proper cover. I would advise you to be very careful about how to choose the insurance policy that you're going to buy from anybody. It could be a neighbor, it could be an uncle, it could be a relationship manager. But weigh all the pros and cons of insurance before stepping into the minefield of called insurance industry in India.
You know, you're right when you say that. Most doctors do tell us that they bought their policies from someone they know well, their patient, their family member, a neighbor, or a friend. And they usually buy it because they're asked to buy, so they oblige. Or they buy because they think they need some insurance cover, it should be there. So, Dr. Vishnatha, you also bought these popular endowment policies, ULIP policies. What has been your experience? In what situations did you buy these? And did you buy it just because someone sold it to you or because you felt the need?
My purchase of insurance policies spans so many years, right from the age of 31 till the age of 60. Initially, I bought insurance just to keep my relative happy. I bought some endowment policy. At the end of the term, when I got the money, I was wondering whether it was worth all the efforts. Then subsequently, it has been my policy to take an insurance cover for any liability that I took. Like, for example, when I took uh, a loan for purchasing my clinics, I took large amount of loan for my clinic as well as my professional work. I took some policy which used to be something called triple cover, double cover, and all that. All the same endowment policy. That means for a 15 lakh worth of policy, I was giving a significant amount as a premium every year. But then after some time came the various ULIPs, which I got conned into. I would say conned into because I didn't apply my mind. Here comes my warning to all my doctor colleagues. Apply your mind very, very carefully. All these insurance agents are trained in conning people. In conning people is not that it's a criminal act, but conning people into buying something with their product is for made attractive to you. They'll say this return, that return. Let's be very clear. Insurance policies are not for returns. They are only for cover of your risk, cover of your life. If it is health insurance, you don't expect any return. Similarly, in life insurance, don't expect any returns at the end of the term.
You know, it's very interesting you say that, doctor. Recently, I met a doctor, a young doctor, about 45 years of age, and he mentioned that he has taken an endowment policy for about 5 lakhs. He said, I'm just paying 25,000 a year. So I asked him for how many years? He said 25 years. And then he said, I think it makes sense. It's a small amount. I can manage it. And then we sat down and calculated. And then he said, oh, I'm paying almost 6 lakhs over the next 25 years for a 5 lakh cover. How is that making sense? He was promised bonuses, but bonuses aren't assured. So then he said, okay, with bonus also, another 2 or 3 lakhs will get added. Yet, how does 7, 8 lakhs after 25 years is making any sense? Suddenly, he realized that these policies give a very low cover, but the premium is very high when you total it up. Even though the premium amount looks very low at that point in time when you're paying up, eventually it doesn't make any sense. So, Dr. Viswanathan, tell us, if I had to ask you, what are the three main reasons why putting your money in life insurance policies as an investment product a mistake? What should people learn from your experience? Why should doctors not be doing this?
Any investment product that you're going to purchase or invest your money in should answer a few questions. What is the return of investment? Will the return beat the inflation? At the end of the term, the amount that you're going to get, is it sufficient to cover your expenses? In all these points, the insurance policies which are touted as endowment policies or various policies which are non-term policies fail in that objective. If you calculate the return on investment in most of the endowment policies of life insurance corporation or any of the private insurance, the return is just hardly 4%. And when you take into consideration the inflation, it is a negative return. And at the end of the term, what you get as a money at the end of the term is so low that you cannot purchase something which you are purchasing now after 20 years with that kind of money. Insurance policies, if bought as a form of investment, will erode your purchasing power. So I would say that don't use insurance policies for investment. Keep them aside for only cover. And for that, cover is only the term insurance policies. I want all the doctors to learn from my mistakes and not commit the mistakes that I committed. Possibly, you have to analyze the product and utilize your knowledge of calculation to come to a decision whether this policy is good for you or not. Possibly because most of the doctors don't educate themselves about investment and insurance. Let us make it very clear. Doctors are in the profession not only for altruistic reasons of treating people, they also have to earn their living. So, in the process of earning the living, they also should learn the capability of protecting their earning, also making the earning grow, which is where the doctors fail. They possibly might be earning a living, but they fail in protecting or making the investment grow. So when you look at the insurance as a structure, there are three people involved. You as a person who is taking the insurance company, and the insurance agent who is the intermediary. In all the three, the person who is investing is the loser. The person making profit is the insurance industry and the agent. It would come as a surprise to you that the insurance agents make first 1 or 2 years about 40 to 50% of the investment that you make in the form of premium. The insurance industry makes its own money. That is why most of the insurance agents are willing to forego their first year's 3 months premium for you to become a loyal partner in the insurance industry. So when they are earning so much, why would they not part with small amount of money to lure you into this kind of a practice? So when you look at this insurance as a form of investment, you got to look at it dispassionately. When you look at it dispassionately, you'll realize that insurance is not an investment, and investment is something else. It could be other instruments, but not insurance. So don't go for any child protection plan. Don't go for any endowment plan. Don't go for retirement plan. Can I tell you about retirement plan? The retirement plan at the end of the term buys you an annuity, and whatever corpus you've accumulated, LIC will purchase an annuity. Annuity is a recurrent money that is provided to you in the form of interest. This the current annuity rate is about 5 to 5.5%, and that too taxable. 5.5% taxable. What do you get in return? 3% rate of return, which is equivalent to your savings bank return at the end of 25 years of keeping the money with you. You think any prudent man should take it? Definitely, I would not advocate.
Yes, right, right. If I have to summarize from what you just said, the three main reasons are: one, the returns from these policies are very low. And that's true because historically, the returns at max have been between 3 to 6% over a 20 to 25-year period. See, as investors, we are trained to look at the maturity amount we will get in our hands, whether it's in form of pension, lump sum, or bonus. And the amount looks big, but when you look at the returns, your money really actually hasn't grown at all. Second, the premium amounts are very high compared to the life cover these insurance policies offer. So it's a case of low cover and high premium. You end up paying 10 times the premium you actually should be paying if you had the right policy. Number three, most of these policies have many charges as a part of the premium. So even if you have, let's say, rupees 1 lakh as a premium amount, don't be surprised if only rupees 90,000 gets invested because the rest of it goes in all these charges. This only means lower returns for the investor. Because of these three main reasons, we should avoid investing in such life insurance policies as an investment product. Dr. Viswanathan, the way these insurance policies are marketed, really, we see so many ads by all these major insurance companies. They all talk about Jeevan Suraksha, Aapke Saath Bhi, Aapke Baad Bhi, Sar Utha Ke Jio, guarantees, etc., etc. And these words give us some amount of comfort we are looking for, isn't it? They appeal to our underlying emotional needs, security for children, old age, taking care of our parents, etc. They look very tempting, very sensible. So, the emotional thought that you or any doctor has while investing is right, because finally it's all about security. But the insurance solutions which are provided are wrong. Doctors don't even know what they're taking. They think that there is something like a child's plan, for instance, but it's just another expensive life insurance policy marketed beautifully. Doctor, you mentioned earlier that only term cover, term insurance, is the one that doctors should take. But we know that very few doctors actually have term cover. A lot of doctors we know haven't even heard about it or don't understand it. Why is that, doctor?
When you look at the term policy, people are not aware as what is term policy because they have not heard about it. Because the insurance agent don't sell it. The insurance agent don't talk about it. Term policy is something similar to what you take on your vehicle, on your car. Every year you pay a premium and you're covered for that period. And at the end of the period, you don't expect then the insurance agent, the car insurance agent to give you any money back. Similarly, term insurance policies cover you for the risk of your life and they don't provide any money at the end of the term. The satisfaction of getting some money lures you into buying this endowment policy or investment policy. But what you get is peanuts as compared to what you pay by way of premium. Take only term insurance, which covers you like you covering your car for the common insurance. Talking about insurance brings me to my mind a story which Dr. Miss R.K. Narayan had written long time back. This was about an insurance agent in a small town. This guy would not market himself very aggressively, but he would be seen in all funeral meetings. In all funeral meetings, the guy will be there with a standard bag under his armpit and with a grave face, will mix around with people. And at the end of the meeting, he would distribute pamphlets about his insurance policies. Because most of the people at that time are in a solemn mood. They're talking of thinking only about mortality. They start thinking that this can happen to them, and they are in a frame of mind where they're willing to accept some talk by an insurance agent. And in the small town, these insurance agents marketing ability was fantastic. Out of 100 people there, even if you have to get 5 people to take policies, his business is made. His policy was taken only during funeral meetings and funeral processions or during cremations. So he says that was the kind of thing that the insurance agents adopt to market their policies. And when you look at the policy which doctors are aware of, there are few. They know about the LIC's endowment policy. They know about money back policy. they know about retirement plans. But when you look at all these things, they are high cost, low cover policies. When any endowment plan or a child cover plan is nothing but covering the parent for a high cost, the total cover will be very low, but the premium will be very high. After you completed 40% of the duration of the term, you already paid to the insurance company much more than the cover that you are supposed to get. That means the insurance company is providing you cover for the policy for which you have already paid. Is a waste of money. But then who educates you? Nobody educates you. Doctors have to educate themselves about the finance, being financially aware. Otherwise, there'll be multiple pits into which you can fall and the returns can be eroded. Similarly, child health plans are also for covering the life of the parents, for providing protection to the child. If you have taken an insurance policy, which is a term insurance policy, and invested the rest in mutual funds or in shares or even plain simple fixed deposit, you would have got much more than what the insurance company is going to give. With all the channels of payment that they have to make, it is a situation where the insurance companies are making money like in a multi-level marketing companies distributing money throughout the line. You don't get any, you get peanuts. And the insurance agent makes more return than what you do over a period of 25 years with your investment. Insurance agent does not put even one paisa of money, but he gets more return than you do. So be careful, educate yourself, become aware of the various policies. And the strongest recommendation would say buy only term policies. Don't buy any insurance plans from insurance industry. That's a bigger scam than anybody can imagine. Yeah, when talking about insurance to medical professionals, when we met in the doctor's lounge in our hospital, once we got talking about insurance, the various aspects of insurance. So I took a poll on the table. There were about 10 doctors, all of them top-notch consultants in the city of Bombay. I took a poll. How many people have got insurance? Almost 70% said they have got insurance. Then I asked them, what is a cover? About 50% of people knew what is a cover. 50% knew, kuch policy hai. That was a statement that they made. And when I asked them what is the people who knew about the cover, I asked them it was for 10 lakhs, 15 lakhs, or at the most 20 lakhs. Then I asked them, what is the value of your car? Everybody was very prompt. My BMW is valuing 25 lakhs. Another person gave them my Audi is worth about 35 lakhs. Somebody came with a car, my Benz is about 60 lakhs. It is S class, it is so costly. Then I asked them, how much do you insure? Of course, for the value of the car. Then I asked them, is it that you have valued yourself so low that you're taking insurance of only 20 lakhs on your life, whereas you are taking an insurance of 60 lakhs for your Benz car? Isn't it incongruous? Then they had no answer, and possibly because they had not thought about it, and they felt that my question was a bit jab in the side to make them come back to the reality. So you should be aware that your life is much more valuable than what the assets that you accumulate. So you should value yourself very high. You look at the kind of cover that you require for maintaining a lifestyle. If you are not around, the family should be well protected, for which you require a very high cover with a low premium and with a long enough term so that your liabilities are well covered.
Absolutely right. In a layman's language, term cover is a no frills policy, and it is the only policy that will give you the highest cover you need for a relatively low premium every year. Let me give you an example. If you take a term insurance cover for, say, rupees 1 crore for 20 years, maybe you're about 45 years of age, the premium amount will come to anywhere between 25 to 30,000 per annum approximately. Now, if you take an endowment policy for the same amount, 1 crore for 20 years, you know what the premium would be? About 5 lakh to 6 lakh rupees per year. The difference in the premium is huge. 25,000 for a term cover versus 5 lakh for a endowment policy. So, in such cases, ideally, what a doctor should do, he should take the term cover, pay 25, 30,000 as the premium, and the balance amount around 4 lakh rupees, which otherwise you would have paid as a premium for the policy, you should invest it. You should invest it in a different product for any of your goals. It could be your child's future or your pension support. With this approach, you're investing close to 4 lakh rupees every year, but you end up accumulating close to rupees 3 crores at the end of 20 years. Can you believe that? Why would you then settle for only 1 crore? By this way, you not only cover your family for 1 crore, but also all your long term goals are managed very effectively. And it also beats inflation, just like what Dr. Viswanathan was talking about. So, in such cases, when a doctor has to choose between different policies, ideally, what should a doctor do? He should take a term cover for 1 crore and pay 25 to 30,000 rupees as a premium. Now, the balance amount, which is close to rupees 4 lakh, which otherwise he would have paid as a premium for the endowment policy, should invest it in a different product. It could be for the goal of your child's future or your pension support. By doing this, you are investing close to 4 lakh rupees every year, but you can accumulate close to rupees 3 crores in 20 years. Can you believe that? Then why should you settle for only rupees 1 crore? This way, you not only cover your family for 1 crore, but also your long term goals are managed effectively. And it beats inflation, just like what Dr. Vishwanathan was talking about. So, honestly, doctor, the need really, I think, is to have a financial doctor in their lives where a right guidance can be given to them. The picture can be made clearer to them so that they understand how their child's requirement or their retirement, these goals can be aligned along with life cover and protection for their family. So, you've told us about your experience, how insurance policies get sold, what we need to be careful about. So, let's talk about solutions now. So, doctor, what is the right thing to do? What are the 3 points that we need to keep in mind while looking for a life insurance policy?
See, doctors should remember that whenever there is a solution needed, you should approach the right professional. If you want your accounts to be properly maintained, you have a chartered accountant. If you have any legal problems, you got the lawyer. And if you have any health issues, you go to another professional, paying the top dollar and get the best of the advice. So similarly, you should have a professional who can advise you on the financial aspect of your life and give you dispassionate, unbiased advice in your interest. Like I've always been saying, how do you choose any of these professionals? Choose the professionals the way a person chooses his son-in-law for his daughter. He inquires, finds out the positives and negatives, and weighs whether the person is reliable or not. Then only entrusts things to them. So you should do your due diligence. If you don't do your due diligence, you'll be stuck with a person who is going to take you for a ride. And insurance is a part of your financial document, and insurance has to be integrated with the whole financial plan which the person makes for you. If a person comes to you with some pamphlets and slips and new fund offers or any retirement plans brochure, shun that person completely. That is because he wants to sell the product. He is not interested in your needs. He's a financial professional who analyzes your need and then provides solution for you in alignment with the specific needs. Is the only person to be trusted. If you don't do that, your money will go down the drain into products which are inappropriate for you, and you might regret it. By the time you realize it, it will be too late. Certain points need to be highlighted. One, insurance should not be treated as investment. Two, you should not buy products like endowment policies, child protection plans, or retirement plans. They give you very bad returns and they cover you very, very poorly. And if a person comes to you trying to sell all these products without knowing your financial need or without knowing your insurance needs, please shun that person. He is more interested in selling the product to you to earn the commission and is not interested in covering your liabilities. I would make a small suggestion. If there is any liability in your life, cover it up with proper term plan. Suppose you're buying a house for 5 crores and you have taken a loan of 3 crores for buying that house. See to it that you have covered your life for at least 5 crores. Any liability in your life should be covered with a term plan insurance for the simple reason. Suppose something happens to you and you're no longer in the picture, the family should not be brought to the streets because you have to repay the bank or the financial institution to repay the loan that you have taken. This is in the interest of protecting your family, protecting the financial needs of your next generation from any ruin that can be brought upon them by the unforeseen event of your demise. So it is necessary to plan for all these events by taking a proper protection plan. Insurance, let me repeat at the risk of being repetitive, that insurance is not investment. Insurance is just your life cover to protect your family against unforeseen events, or if the person were not to be there in life for the in the future. So if you are going to take insurance, stick to plain and simple vanilla insurance, that is term cover. Don't take anything else.
Yes, doctor, we've seen that. Most doctors, when they take an insurance policy, they just pluck a figure out of the air, something that just seems adequate. They rely on the insurance agents to propose and decide a policy. But that is not the way to make this most important decision. Now, again, there are no thumb rules here. Everyone's needs are different, just like every patient is different for a doctor. And the only way of deciding how much insurance you need is by having a proper calculation done for you. And there are methods, there are two, three methods which are used. And they give a very good idea of the amount of cover your family really needs. They take into account your possible earning life, your loans, your future expenses like education, marriage, etc., your dependents, living expenses, the assets you already have, and a whole lot of other things. Let me tell you about this doctor family, very successful, passionate, running a 100 crore hospital in Mumbai. So the doctor told me that he had a life cover of some 3 crore rupees, and he asked me, that looks good enough, no? He was paying a huge premium of 26 lakhs per year. He had invested in more than 27 policies of small, small amounts that made up this 3 crore cover. Mind you, this was a doctor in his late 50s with more than 25 years of experience. And somehow he had obliged his agents, patients, and collected all these policies over the years. Now, when I got talking to him, I got to know that he was in the middle of his hospital expansion and he had an outstanding loan of about 10 crores. So I asked him, God forbid, if something were to happen to you, how will your family pay off this loan? They would have to sell some of their assets to pay up. Rupees 3 crore does not seem adequate, right, to cover this? And it struck him. And he realized his mistake. He realized that his need was never calculated for him. He just looked at these policies as some sort of backup. People sold it to him, and it was more like investments. So finally, we covered him with a term cover of 15 crores. 10 crores to cover his outstanding loan amount, and rupees 5 crore for his family needs that may come up in case anything were to happen to him. We analyzed and stopped all the unnecessary policies out of the 27 that he had. Do you know how much he saved in the form of premium? He had to pay a premium of only 4 lakh rupees for his 15 crore term cover. And what he was paying earlier? 26 lakhs for 3 crore cover. Saving of almost 20 lakhs in a year as premium. Plus, he was worry free, his family was covered fully. This is how calculations need to be done, and only term cover, therefore, should be taken. Dr. Viswanathan, also, if you could help us understand this. Insurance policies, like we spoke, are marketed beautifully, emotionally. And even informed doctors like you end up believing in it and buy these insurance policies. What is the reason? What are the thoughts in your mind when you look at investing these insurance policies?
The problem with the mindset of doctors is that for them investment finances are not very comfortable terms to handle. They are not used to handling numbers in terms of future worth of money, the current worth of the future money, and all these calculations are beyond them. So many times they take decisions, financial decisions, without calculating what is into it, well, how they are into it, and in what way is going to impact their financial wealth, financial health. So don't look for investment as a investment vehicle in the form of insurance policy is my categorical statement.
That is so true. That gives so much clarity. Thank you, Dr. Viswanathan. This was a great experience and great learning. I'm so glad that you candidly shared all that you went through, all that you wanted to tell your colleagues, and you gave them pointers on what they should avoid so that they learn from your experience. It was wonderful having you. Thank you for taking the time out, Dr. Viswanathan. Thank you so much.
Thank you, Ms. Verma. If you ask me why am I talking all these things on a podcast, because I realize at the end of my professional term that I have made multiple mistakes, which, if avoided, could have increased my financial capability significantly. I want the medical profession to avoid all the mistakes I committed and be financially happy, extremely wealthy in future, and without putting in double the efforts to earn the money that they are due to be earning. Thank you so much.
That was a beautiful conclusion from Dr. Viswanathan on why investing in insurance policies as an investment product is a costly mistake for doctors and should be avoided. This brings us to the end of this episode. But do tune in to the next podcast, which will be on the second most important mistake doctors need to avoid, which is fixed deposits. Be safe, be secure. Thanks for joining in. Take care and God bless.
You were listening to the Personal Finance Podcast for Doctors with Chanda Varma. If you find this podcast relevant and interesting, it will be great if you leave a review, share, like, subscribe, and share it with other doctors. You could also let us know if there is any specific topic that you would like us to cover. For any queries or help, you can get in touch with MFA's Doctor Practice Team at 959 40 62326. That is 959 406 2326.